no segment, LPG must be really confusing because analysts don't seem to appreciate it enough, other than ours. Investors don't seem to appreciate it enough. In the last decade, 5 years, I don't care what period of time you want to look at, no segment in shipping has had a higher return on equity, returned more cash to shareholders, and traded at a bigger discount to NAV. So clearly, LPG is complicated. So Randy, you used to be an analyst. What is LPG and how do we use it?
So for LPG, liquefied petroleum gas, right, the biggest portion is propane, using for heating, industrial uses, and other things. For Navigator, I'll let them speak more on propane. That's kind of their specialty. For Navigator gas, right, we're trading a lot more commodities. We're trading ethane, ethylene, which is then used for polyethylene and polymers and plastics. We're also trading ammonia, right, which is the key input for fertilizer, food security. We're looking at butane, butadiene, propylene. So there's really 7 different commodities that Navigator's actively trading today. Anything from industrial uses to consumer demand products, plastics, and other things. On the LPG side, I'll let these 2 experts talk about where that's going and what's that being used for.
Well, your business sounds a lot more exciting than ours. But look, LPG, as Randy said, propane and butane, about 53% of world demand is for heating and cooking, which is great. It gives us some base inelastic demand. No matter what happens economically, you need to be warm and you need to eat. Next biggest segment is petrochemicals, and there's sort of 2 sub-segments in that. Portion of that is goes into steam crackers as a feedstock, and it can be swapped out with naphtha. So one of the arbitrages that Anders and I look at every day is the arbitrage between naphtha and LPG. On the other hand, there's been an emergence in the last several years of an old technology that sort of found its time, and that's propane dehydrogenation, which is a direct on-purpose way of taking propane and making propylene. And the beauty of that from a shipper's perspective is that there's no bit away from naphtha. So in fact, it doesn't seem that confusing to us because most people understand it's used for heating and cooking. I can't take you through the chemical reactions, but I can tell you it's petrochemicals, and people should understand that. And the rest is things like auto gas and industrial uses, like you'll see it, powering forklifts and that sort of thing. So I agree with you, Jim. It's actually a pretty simple business, so I don't know why we don't get the love.
It's clean, affordable, and flexible. It's actually, and we'll talk more about that, it's actually one of the few energy sources that I think has a great, both the short-term future and long-term future. So we'll come back to that. I also think you guys are lucky. You're sitting in this room, of course, the small room. Put up here, it's not a packed audience. That means great opportunities. You know, if it was packed, everybody was doing this, returns wouldn't be so good. So you're the lucky ones.
Well played.
So today, Randy, not for you, but today for the very large gas carriers, they're getting $74,500. 2 weeks ago, they were getting $85,000. This is a Q1 from heaven. What happened to all the ships that were ordered and delivered? Are you surprised?
Do you want to go first? You want to go?
I think we're slightly surprised. Normally, first quarter is our weakest. And we always think in the start of the quarter we should, hedge a little. And so we thought we did some great deals at 40 plus. Don't look so great now. I think we were slightly surprised. But of course, I think we underestimated the pent-up demand from China. They really need to refill their inventories. We had some cold snaps in Japan and Korea, which really also, made a big difference. And I guess of course the order book it's spread out a little bit. We're seeing it spread out over the year, and I think we might see an effect during the year, but at the same time the underlying fundamentals are good enough. So I think certainly our concern is less.
And before we go on, what are you seeing in India? Because that's an important part of your business.
No, I mean, we see still great demand in India. India is a very important market for us. We have established there an Indian company, JV. We have eight Indian flagged vessels, and where we're getting both premium rates and first right of refusal. So it's been an important investment for us. We see no slowdown in demand in India, and we think India is going to be a great market for us also for a long period of time.
And Ted, $70, $80 a a day.
No, it's fantastic. I kind of share Anders's view. I think we're probably pleasantly surprised given the order book, but I think, look, in any segment of hydrocarbon shipping, a favorable commodity price deck absolves a lot of sin. And, right now things are firing on all cylinders. The East-West ARB is good. The LPG naphtha ARB is good. So when our customers are making money, it's kind of hard for them not to allow us to make money, and they become much less price sensitive because the returns they can make on moving a cargo and if you have a ship available for their windows, it's a pretty favorable set of circumstances, and that's obviously what drives the rates we're seeing today.
And Randy, what's the range? You've got the smaller vessels for the most part, and you've got different routes. What are the range of day rates that you're seeing, and the level of utilization that you're seeing in your segments?
Yeah, so the vast majority of our ships are called handy-size vessels. They're about 22,000 cubic meters compared to the very large gas carriers that are 75, 80, 82,000. So we're about a quarter of the size in that regard. But we're not making $75,000, $80,000 a day. But 2 weeks ago, we had our highest rated or highest priced cargo ever in the $50,000 a day for a 45-day round-trip voyage. So clearly rates are very good. Utilization, as you asked about, we reported 4Q earnings this morning. 1Q is going to be even better than that, right? Our utilization's at 98%. Right now, the highest since 2014, 2015. So utilization's very strong, rates are high, and that's for ethane, ethylene, propane, propylene. And the good part for our handy-size ships, again, we have that kind of diversification around commodities. So fewer and fewer of our ships are trading propane because more and more are trading ethylene, taking it from our terminal, frankly, to Asia and to Europe. And we have about 20% of our vessels trading ammonia, right? So it's really split against those three different segments, and that is pushing up rates, keeping utilization high, and 1Q23 is looking very good.
All right, let's go back to, let's try to make LPG simple again. So you don't necessarily need to, and this is for anyone, you don't necessarily need to have U.S. oil prices super high. You just need to have U.S. oil prices at a level where production grows, because as nobody drills for propane, so as you find more oil, take us through the math of how much LPG you find and how important is the arbitrage between prices, cheap prices here and more expensive prices, in Asia.
I think you do that since you're the local.
Oh, I'm the local, okay. Yeah, so to answer those sort of in reverse, it seems like the sweet spot for, at least judging by how investors think about it, and I guess how the industry looks at it, somewhere in that $60 to $80, maybe $85 a barrel range always seems to be pretty good, because, like Jim said, there's significant drilling going on, significant production going on, but it's also not stifling economic growth or creating an overly inflationary environment, which is kind of important. No one has ever produced a metric ton of LPG on purpose. It kind of varies, so it does come from two sources, well, really three, but it comes from oil and gas production and oil refining. In the U.S., we actually get more of our LPG from natural gas production, about 60-40, whereas the rest of the world gets it more from oil production. How much, Jim, really depends on where you're drilling. Right now, the Permian's in favor, and where they are drilling in the Permian right now is particularly natural gas liquid rich, and that's great for our business because there's plenty of NGLs coming out of the ground as they're drilling all this oil and gas. And look, this is gravy for these guys. In the old days when guys used to flare LPG, that was one of the things you'd see coming out of those stacks in the oil patch. They had nothing to do with it. Well, now there's substantial global demand for LPG. As Anders said, it's a clean fuel. It's got all sorts of wonderful environmental attributes, properties. And on top of that, it's relatively cheap to transport, and we don't require all the major last mile infrastructure and shoreside infrastructure that LNG does. So from that perspective, the setup is good. Again, so what do we see going on? The economics are favorable for drilling, particularly in the Permian, but also, and I'm probably getting ahead of the questions here a little bit, but as we've seen Russian oil production shift away from Russia and towards, say, the Middle East and also the U.S., last year we saw double-digit export growth from the Middle East in LPG. We haven't seen that in quite a while. And that's really a function of that. Russia was not a big LPG producer. It produced sort of 6 million metric tons of LPG. About 2.5, 3 million of it went out of Ust-Luga, where Randy ships would call, and the rest of it went on rail cars to Central Europe and the stands. So it didn't really affect our business, but what has affected our business quite positively has been the shift of oil and gas production to other parts of the world that have a more robust LPG export infrastructure. And so from that perspective, we continue to see favorable growth.
And I don't see any capacity constraints either in the U.S. at the moment. Of course, U.S. is still the most important market for us, and so I would just echo that. I think as long as we see decent prices, oil and gas, we will have LPG.
So let's talk about the macro environment now, and let's pretend that the U.S. goes into recession. Let's pretend that Europe slows down. Is that something we need to worry about, or can India and China continue to absorb all the supplies that we come out of the U.S. and Middle East?
Yeah, I'll chime in quickly. Shipping is certainly a cyclical business, but it's more cyclical for China and India, right, than the U.S. So for us, lower prices domestically and higher prices internationally make a great combination, right? So that spread that they were speaking of, when you have a possible slowdown domestically here in the U.S., but India, China reopening, and demand there continues to climb, we like that, right? That's fine for our spreads. For ethylene, for example, right, when you have U.S.-based ethane at $400 a ton, U.S.-based ethylene at $500 a ton, but delivering it into Asia, you're getting $1,100 a ton, or even Europe, $1,000 a ton. That $500 to $600 per ton spread is meaningful when it comes to the freight that you can charge for that. So, frankly, it's certainly, we are part of the global economy, but as long as China and India is ramping, if the U.S. kind of slows down, it could be good, but certainly could be still okay for a company like us.
I still think that in our market it is supply driven. I think as long as there is supply, it will find a home, and that's why we see again when there's plenty of inventory in the U.S., it has to be moved, and we do see the price goes to a level where it moves, and I think that's really important. I think LPG is also. We don't need a lot of investments in infrastructure, so even in the slowdown in the economy, I think we can still see LPG as a very attractive energy source. So I think the demand side to me is not a big concern.
And I think I agree with all that, and I think in addition, look, there is a favorable secular shift going on in the petrochemical segment, right? Naphtha's dirty. People, there's a lot of environmental pressure not to use naphtha. And so as we talked about, 50+% of LPG is really sort of base energy demand for large portions of the world. So we've got that going for us. We have a secular shift going in our favor in the next sort of 25 to 30% of world demand. So look, global recessions affect everybody. That petchem segment is affected by global industrial demand, and that's certainly going to be affected in a global recession. But on the other hand, I'd expect to see LPG hopefully take an increasing portion of that pie, and even in the event of an economic slowdown.
Let's just jump to LNG for a second. Did the high natural gas prices of this past September, August, Q2, did that help LPG demand? Conversely, is the weakness that we're seeing in natural gas prices now, is there a risk that could eat back some of the pie?
I think we saw some effect of the high price differential between LNG and LPG past year, but it was not meaningful. It was not. It didn't move the needle when it came to demand. And I think although we saw some mixing of LPG into LNG flows and so forth, but it was difficult to get a good number of what it actually meant. So to me, it didn't move the needle at that time. It's not going to move the needle this time either, even though we see weaker LNG prices.
I think that's probably accurate. I think where I'd say, look, the differential on a dollar per BTU basis was massive, but LPG and LNG generally are not interchangeable. But obviously, it did help us a little bit because that encouraged more LNG production. But it also, as markets always do, it encouraged more coal consumption in Europe, and nobody likes coal. So now the LNG price is back down. Still levels where it's very profitable for guys to produce. So I think I think Anders is right. It probably didn't hurt us too much on the way up. Probably doesn't hurt us too much on the way down.
Randy, geopolitics, how has that impacted your trades in the last 12 months?
Sure. I guess starting with Russia, Ukraine, right, the biggest thing that we saw the impacts is on ammonia, right? So instead of Western Europe importing ammonia from Russia and Ukraine, they did not, right? They were not able to, so they had to look further afield, be that here in the U.S. or Latin America or Middle East. So they had to get it from longer distances. Secondly, a lot of the Western European countries stopped using natural gas to produce ammonia, right? They needed it for more important things. So because of that, we went from 2 or 3 ships trading ammonia a year and a half ago, kind of before the war broke out, to a peak of 11 vessels. We have 57, so about 20% of our vessels trading ammonia. So that ammonia trade really took off following the Russia-Ukraine war, and it's continued that strength. We saw some other dislocations. There's Iran. We had a cabotage trade in Venezuela. So there's a lot of geopolitical events that are affecting our business. But for the most part there, I think the Russian-Ukraine, I think that's top of mind for everyone still today. That's been the biggest impact on the ammonia trade for us.
And as far as the VLGC segment?
Yeah, I mean, there's no VLGCs aren't really trading in the Black Sea, so we haven't seen any of that. As I touched on, we've clearly, as a sector, benefited from the shift of oil production away from Russia towards the Middle East, which has produced more LPG. But Iran has always been a constant thorn in the industry side. There are about 12 ships that are sort of dedicated to that trade. They're quite old. That's all they can do. Anders and my firm don't touch that stuff for obvious sanctions reasons. So again, it's been sort of very laser focused in terms of its impacts, I'd say.
No, I think we are one of the sectors that benefited from it. I think clearly, as you said, production going up in the U.S., because energy prices simply really is helping us. So I think we've been benefiting from these troubles. Now, of course, with the recent sort of issues now on the banking side and so forth, it'll be interesting to see how this plays out, because I think. Obviously, there's been talk about ESG earlier today and how important it is to be compliant. I think as an industry, we have already made some great strides, and I think LPG is going to prove to be a longer-lived fuel and a longer-lived energy source, just simply because there's going to be questions asked now. How quickly can we make this change? How quickly can we go from fossil fuels to this green? I jokingly say with some of my banking friends, are you sure you're going to get your money back? And I think that's a relevant question right now.
So let's go back to how securities are valued. And so if I do a screen on price earnings, which I don't like, enterprise value to EBITDA, price to NAV, I don't care how I screen it, this segment stands out as being crazy cheap. So we can't tackle it all, but at least let's talk a little bit about the NAV. And pushback I used to hear a couple of years ago was there's not enough secondhand sales to justify the NAVs, but that's kind of changed because you guys have all bought and sold vessels. Take us through that.
I'll start. Since I think we sold more than 20 ships in the last 3 years. We sold them at 35% premium to our book values, closer net asset values. And so I think that shows that this market has become more liquid. Of course, the fleet is getting larger also. So the net asset value argument that we should not trade close to net asset value, I think, does not hold anymore.
Yeah, I'd say, we sold some ships as well. I think, look, there's ample evidence of secondhand values. Okay, I can respect the fact that notwithstanding the bevy of sales of, I'd say middle-aged tonnage, sort of 8 to 12 years, there have admittedly been almost no transactions involving modern tonnage. So that probably does put a little bit of a damper on R2 valuations. On the other hand, if you look at, another way to look at it, Jim, which is free cash flow to equity to market cap, both of our yields are ridiculous. That's great for investors. Why we're not getting credit for it? Well, that's, I'd say a perennial source of frustration, but it's not only is the floor, we can debate the floor, i.e. being NAV, but the cash flow yield is really quite compelling. And I'm looking at an equity basis. So, taking account of, look, you can either don't add back depreciation, take that as a charge for maintenance, CapEx, look at the actual dry docking expense, do whatever you want. But after debt service and, making sure that we're keeping our ships properly maintained, not just for the here and now, but for the long term, these businesses generate extraordinary returns to equity, and when measured against the market caps, it's quite eye-opening.
Just before Randy, before you go, I think also, of course, we suffer a little bit that we're a small sector. We're not a lot of big companies, and it's, as you said, Jim, it's a little hard to understand. It's this byproduct, and it's but hopefully with these panels and with good communication and just at least demonstrating value creation, I think over time, investors will appreciate that.
Yeah, and then to speak on the NAV, as an analyst, right, I covered 6 different sectors. LPG was one of them. And for dry bulk, for crude tankers, products tankers, even container ships in recent years, there was a lot of liquidity in the secondhand market. So I could easily say a 5-year-old Cape is worth this, a 5-year-old V is worth this, a 5-year-old 6800 TEU container ship is worth this. On the LPG side, it was a lot harder to value, right? And we're working with Vessels Values and others to kind of bring them up to speed. But we sold our oldest ship a few months ago, the Magellan. We bought 5 secondhand modern ships in the meantime. So there is starting to be some more liquidity in it. But as you mentioned, we are certainly undervalued relative to a EV/EBITDA multiple, to a price to NAV, and we're putting our money where our mouth is, right? We announced a $50 million share buyback program a few months ago. We announced this morning that we already used a little more than 25 million of it. So we have about 25 million left, and we continue to remain in the market. So I think there's certainly that disconnect between earnings and equities, and we've seen that over the years, and we're certainly seeing in the last 2 weeks.
So your stock is trading at less than 70 cents on the dollar of NAV, including today's rally. Your stock is trading well over 80 cents on the dollar. Is there a listing arbitrage here? Ted, you take it.
I think the short answer is I don't know. The common wisdom from folks in your seat, Jim, has been that as we're going into a higher cycle, the valuation metric shift from PNAV to price earnings. And the Norwegian market is historically always been, dare say, religiously devoted to price NAV multiples. So, perhaps in that regard, there is a bit. Looking at R2 securities, obviously, different people have different methodologies for valuing NAV. There's also, currency noise that goes into the BW stock. It's quoted in kroner, or quoted in dollars. There's noise. I don't know that there's a listing arbitrage, but there may be times in the cycle when one market over the other prizes different things.
I think there is a liquidity argument. I think clearly the U.S. market is deeper and more liquid, and of course the investor base also is greater. So I think Ted, you're right. Also, I think in Norway, traditionally, it's always been priced NAV that's been the focus. And to me, I think that's frustrating. I think we should be viewed on returns. And you know, I think last year we had a return on capital employed of above 12%. I think that's pretty good.
Let's circle back to where we would have started if I didn't go on this educational path of LPG and give each one of you, because your businesses are each different. So, Randy, I'll start with you. Take us through your business model and your business.
Sure. So yeah, as I mentioned, our core is really that 22,000 cubic meter handy-sized vessels, giving us a lot of optionality around what ports we go in and out of, a lot of optionality on the commodities we carry, right, up to 7. So that's kind of our bread and butter. But also, we have a large project for an ethylene export terminal. Our partner there is a 50-50 joint venture with Enterprise Products Partners, the large midstream pipeline company, and that's down in Morgan's Point, Texas, about 20 miles east of my house in Houston. So with that, we are exporting ethylene. We announced recently that we are expanding that. So we already have capacity for 1 million tons per year. Last year, we just announced this morning, we did around 987,000 tons, right? So pretty much right at nameplate capacity. And demand is there. So we are expanding it by somewhere between 550 to possibly up to 2 million more tons. So there's a large range here and some project details, but it's going to be a substantial expansion. So that gives us a lot of cash flow stability, cash flow visibility from the offtake, and it also pushes more ethylene, more product onto our ships that we're taking to Europe, that we're taking to Asia. So for that, you know, our volatility, even back to the shipping side, great day rates for us on a 1-year time charter on a handy-sized ships, maybe $35,000 a day. Bad rates for us is $15,000 a day. So that's really our range, right? In our EBITDA break-evens, less than $10,000 a day. So we are always cash flow positive, always positively generating EBITDA. So that's our cycle, right? A lot less volatile than the Vs or VLCCs or Capesizes or a lot of other sectors. So, you know, people talk about the shipping and the volatility in shipping. It is there, but relative to other segment sizes or other shipping segments, Navigator is certainly more muted, plus the cash flow visibility from the terminal side. So that's why I think our valuation on a price to NAV, that's one way to look at us, but also on the EV/EBITDA, right, because of that more stable EBITDA cash flow generation. Balance sheet is in arguably the best shape we've ever been in, no maturities till 2025. So a lot of good things going on over at NVGS.
Ted, take us through your business.
Okay. So look, Dorian is major owner-operator, I guess second largest in the industry behind our friends here at BW, of VLGCs. That's all we do. We're a proverbial pure play. We kind of talk through the dynamics of what drives our business. We jointly operate a pool called the Helios LPG pool with our partners at Phoenix Tankers, which is part of MOL. We have, therefore, a virtual presence in Singapore to go with our physical presence in Copenhagen, where we do the rest of our chartering. We operate our ships technically in-house. We think that is an advantage. We believe it allows us to be immediately responsive to any issues as they arise. We think that certain charterers prize that. Again, we have similar fundamentals to our peers. I'd say we have taken in recent times we've been actively paying dividends. Our peers have too. We have classified ours and continue to classify ours as irregular. We think it is challenging for shipping to be tied to mathematical equations to dictate what sort of dividend policy one should have, because shipping's volatile, as we've all said, and eventually the tide will turn and people will have to cut their dividends. We have, sort of 3 months of really good cash earnings visibility, and that's the basis on which our board makes its determination for dividends. We'll continue to do that. Our investors have seemingly been very happy, judging by our total shareholder return over the last 18, 24 months. And so I think, as we look forward, we will continue to be smart allocators of capital. If you look at this year, we're taking delivery of 4 ships, one of which we will own. The other 3 are on long-term time charters with purchase options. Why? Because we could not build the ships at the cost or at the charter rate at which our owners are going to receive on the deal we're going to do. So again, it was smarter for us to time charter in those assets than it was to build those assets. We got into the right point in the cycle on the one new build, and those returns work for us. So again, we want to continue to be disciplined capital allocators, benefiting from the secularly favorable trends in global LPG transport, most of which inures to very large gas carriers. We're the cheapest way to transport a metric ton of LPG long haul, and that coupled with a smart capital allocation strategy should deliver good returns to investors.
Yeah, as Ted said, we are the largest VLGC owner. We own and operate 48 ships. We've been the largest for a long time. Still 3 years ago, we decided we need to look at our strategies. How can we secure that position? We saw, several of our customers, traders, ordering ships and moving into our space. And so we made a decision. We need to renew our fleet. And that we did by making an investment decision. We were the pioneers of these dual fuel LPG engines. So we now have converted 15 ships, and they're all on water, to LPG. They can run on LPG. That's both from an environmental perspective, of course, very positive. It's also financially making good sense for us. We're earning about $5,000 a day extra by burning LPG. And so that was an important decision for us. And we've been selling, as I said, old ships and really at good prices. We also decided we need to look more into the value chain. And so we dipped our toes. We looked into product trading. We started in a small scale 3 years ago, and we've been trading then 1 million tons the past couple of years. Now, just a few months back, we announced the acquisition of the LPG trading team from Vilma, and that integration has gone very well. We decided this has given us, much better information on the product flows, much more optionality, opportunities to long-term contracts, and of course we want to make money on it too. So that's been to us a very important investment decision. There's always concern when you go into trading, because of course our customers are thinking, okay, are you going to start just talking your own book, or are you going to be still a good quality shipping operator? I'm very proud of the fact that we announced this in our last earnings update. Vitol has actually put 4 of their ships into our pool, and I think that says something about the quality and the respect they have for our operations. So I'm very happy about that. Of course, also with the good times, we've also stepped up our dividend policy. Until recently we had the policy we pay 75% of our net profits when our leverage below 30%. We also just announced when the leverage goes below 20%, we'll pay 100%, and I can promise you that's not far away.
That takes us to the end of our time. If there's something that you're dying to say, now would be the time to say it. If you want to ask a question, you could either ask it now or when we leave the stage. And I thank you gentlemen for joining me today, and I thank you for listening to us.
Good job, Jim.